Everyone has brains to make money in the stock market, but do they have the stomach? Well, while you were going to get your Pepto-Bismol, the Dow Industrials and S&P 500 just crossed above all-time highs, and on today's show I've got updates, the very latest stock market trends. We'll take a look at industry sectors and all the ETFs tracking them right after this. I'm Ron DeLegge with ETFguide TV. Thank you so much for joining me. It's great to see you. And I've got a few charts in today's episode with the latest trends with the stock market, and I'm going to share that with you. We're going to examine the major benchmarks like the Dow Industrials, S&P 500, the NASDAQ, as well as bonds versus stocks. And then we'll take a look at some industry sector groups like technology, which have struggled. And then we'll also look at energy and financials. Plus, we'll take a look at some catalysts for what comes next for the stock market. Before we do that, is anybody watching this at, near, or already retired? Because if you are, I've got a brand new ebook titled 60 Smart Ways to Retire Better, and it covers key topics like maximizing Social Security, avoiding distribution pitfalls, and I know that you're going to enjoy it. It's free, and the download link is provided below, so be sure to get your copy. So let's, without further ado, take a look at our first chart, and this is the CNN Fear and Greed Index. And I always like to look at this because it gives us a real quick snapshot of the market's sentiment or mood. And you'll see right now we're neutral, which means that the overall market is not at extreme readings of fear or greed. And that's pretty interesting because whenever you have a stock market hitting all-time highs as we did this past week, I mean the Dow and S&P, if you've been out to lunch, if you've been napping or hibernating, both indexes touched all-time highs. And usually when that happens, it's associated with extreme optimism, yet we're not seeing that reflected in the latest CNN Fear and Greed Index. Now here's our big picture look at the big three benchmarks and the ETFs tracking them. DIA represents the Dow Industrials, S&P 500, SPY, and then the triple Qs track the NASDAQ 100. This is your side-by-side look. This is a year-to-date performance chart, which means it's from the start of January 1st up until the market close of March 26th. And you'll notice that the tech-heavy triple Qs is underperforming. And up until up until mid-February, it was outperforming the Dow and S&P 500, but has since lost its momentum. And even for a brief moment there in early March, it dipped to 4.5% loss, but has since recovered and is now flat. But all these tech momentum stocks, as a group, they've been decelerating performance-wise. And so we've seen, as those of us that have been participants in this market and observers, we've had a great run in some of these high-tech stocks really since the coronavirus crash. And so what we're seeing now is a healthy pullback, and these stocks need to consolidate. Markets need to inhale, exhale. That's a normal part of the process, breathing. We never want to see markets that just inhale all the time or exhale all the time. So that's what we're seeing right now. And these stocks are consolidating before they can make their next move higher. Next up is the conversation of stocks versus bonds. Now, the Schwab ETF that tracks the total U.S. Stock market, and this includes large, mid, and small company stocks. It's a better representation of the U.S. stock market compared to, let's say, the Dow Industrials or the S&P 500, which just focus on large company stocks. So SCHB encompasses the entire U.S. market, and you'll notice that bond prices relative to SCHB, BND, has been hurt because of the rising interest rate environment, and you see that's not good for bond prices, and that's why you see ticker symbol BND underperforming. Here's a side-by-side look at the two top-performing S&P 500 sectors. That's ticker XLE, that's energy, and financials, XLF, and then XLK tracks technology stocks that are in the S&P 500. You'll notice XLF and XLE pulling an MC hammer on tech. You can't touch this. And so that's something that tech hasn't had in quite a while. But this is the current trend for 2021 thus far. Here's another look at the hot momentum stocks within the S&P 1500. You see, you learn all kinds of stuff when you watch ETF Guide TV. A lot of you didn't even know that an S&P 1500 benchmark or index even existed. The S&P 1500 is a combination of the S&P 500, the S&P Mid Cap 400, and the S&P Small Cap 600. So when you add those three up, and it's fourth grade math, you get S&P 1500. And as this chart shows, the stocks that were performing the best up until mid-March are now down 11.5% on average. So they've gone from best to worst faster than you can say Rumpelstiltskin, and market sentiment can and does change on the dime, and this chart is proof. So our final chart of the day, now that the S&P 500 and Dow have at all-time highs, what are the next catalysts to move the stock market? Will it be earnings? Well, as the first quarter ends, so far we got 94 S&P 500 companies that have issued earnings per share guidance for the quarter, and of that group, 60 to be exact have issued positive earnings per share, while 34 have issued negative. So the number of companies that are issuing positive guidance is beating the ones that are issuing negative guidance. And, you know, to all those companies issuing negative guidance, I sometimes think that they do that purposely to beat down expectations and then to surprise the market with an earnings beat, which gives a surprise jolt to their stock price. It's something that happens a lot. One final look at S&P 500 by industry sectors. So if we divide the S&P 500 by industry groups, you've got 11 sectors. And as we examined, we looked at technology, we looked at financials and energy. And the last time we did this type of video, looking at the markets, there were two sectors that were negative. That was utilities and consumer staples. Well, since at that time up until now, they have joined the party and they're now in positive territory. So now we got all S&P 500 sectors in positive territory on a year-to-date basis, which is quite bullish because it indicates broad market participation by all industry sectors. And that's what you want. That's what you want to see if you're a bull. Broad participation by all industry groups. And so some key takeaways from today's program. Well, sentiment towards stocks is still bullish, but it's not extreme. Also, the greed and fear index is neutral, which is kind of surprising. Like I said earlier, usually you see when market is topping or hitting all-time highs, there tends to be excessive optimism. Well, we don't have that right now. We've got all 11 S&P 500 sectors in positive territory. That's good. And so, as a reminder, now is a good time to have your safety net. Put it in place. Keep in mind that a rising market, as we have right now, is the right time to add or implement that margin of safety. That's your portfolio's safety net. Like insurance, you acquire it before the accident, before the fire, before the storm, before the destruction. Not during and certainly not after. So you install your margin of safety before a market correction. And like I said, you want to do this when the sun is shining. You don't want to do it when it's hailing cannonballs from the heavens. So reach out to me. Those of you that would like me to analyze and grade your portfolio, I'll be happy to do that. And I hope you've enjoyed today's episode. We've talked about a lot of good things. So how did you enjoy today's episode? Well, be sure to hit the subscribe button and don't forget to hit that like button if you've enjoyed today's program. Post your comments below. Let us know how you've been enjoying our programming. I offer online classes. Of course, I offer the portfolio grading service. And don't forget to check out our other programs like ETF Battles. I'm Ron DeLegge. We'll see you next time. Take care.